A welcome, friend. Today we're diving into 4 tax credits that make a real difference for families. My goal is to take something that often feels confusing or overwhelming and make it warm, simple, and real world ready. By the end of this lesson, you'll understand the major credits available to families and how they might apply to your situation. This is all about clarity, confidence, and helping you to keep more of the money you work so hard to earn. Here's our roadmap for today. We're focusing on 4 major credits that create real savings for working families. Each one works differently, but together they cover everything from income support to childcare to education. Think of this slide as your guide for where we're headed, and I'll walk you through each credit in a way that feels simple, clear, and real world ready. On this slide, you're seeing the maximum earned income tax credit amounts, and they're shown by tax year and by the number of qualifying children. For 2025, the IRS has already released the full set of EITC amounts, so you'll see $7,152 is the maximum credit for families with 2 children, and $8,046 is the maximum for families with 3 or more children. Those numbers are locked in for the 2025 tax year. For 2026, the IRS has only released the updated amount for families with 3 or more children so far, and that new maximum is $8,231. The 2026 amounts for families with 1 or 2 children haven't been published yet. The big takeaway is this: the EITC grows as your number of qualifying children grows, and it adjusts each year for inflation. That's why you're seeing slightly different numbers across 2 years. To qualify for the earned income tax credit, you must have earned income, wages, self-employment, gig work, or tips. The income limits vary based on your filing status and how many qualifying children you have. One number I want to highlight is the 2026 income limit for married couples with 3 or more children, which goes up to $68,341. That's the highest threshold in the EITC's chart. This is why we say most working families earning under about $66,000 to $68,000 should check their eligibility. If you don't have children, there are age rules. You must be between 25 and 64. If you do have qualifying children, those age rules do not apply to you. There's also an investment cap. For 2026, the investment income must stay under $12,200 to remain eligible. Going over that amount disqualifies you even if your earned income is within the limits. Just to give you a real-world picture, a married couple with 3 children earning around $60,000 a year could still qualify for the EITC. The credit is designed to support working families, even those earning moderate incomes. The child tax credit is now permanently set to $2,200 per qualifying child, and that amount stays the same for 2026 and beyond. Part of this credit is non-refundable, which means it can lower your tax bill all the way down to 0, but it can't give you money back by itself. The other part, which is the additional child tax credit, is refundable. That's the portion that can turn into actual refund check if your child tax credit is larger than your tax bill. To qualify for the refundable portion, you need at least $2,500 in earned income, and the refund is calculated using a simple formula. 15% of your earned income above $2,500 up to $1,700 per child for 2026. Together, the CTC and the ACTC can return up to $2,200 per child to your family. For a household with 3 children, that's up to $6,600 in total support. Your child must meet all 6 requirements to qualify for the child tax credit. These include age, relationship, residency, support, dependency, and having a valid Social Security number. Most families fall well within the income limits, so they receive the full $2,200 per child. And if your child is 17 years or older, they no longer qualify for the child tax credit, but you may still receive the $500 credit for other dependents as long as they meet the support and residency rules and you claim them on your return. The Child and Dependent Care Credit helps offset the cost of care so you can work. Eligible expenses include daycare, preschool, after-school programs, and even summer day camps. The credit is based on a percentage of your care expenses, anywhere from 20% to 35%, depending on your income. Most families fall into the 20% tier, which is why the maximum credit for 2 or more children is $1,200. This credit is non-refundable, meaning it can lower your tax bill, but it cannot create a refund on its own. This slide breaks the Child and Dependent Care Credit into 4 simple rules: who qualifies, which expenses count, what doesn't count, and how dependent care FSAs fit into the picture. These rules matter because the credit is based on 2 things: your eligible expenses, and the percentage you qualify for is based on your income. To make this real, let's walk through a quick example. Imagine a parent with 2 children who spent the full $6,000 on care so they could work. If their income is around $25,000, they qualify for the 35% rate, which means they could receive up to $2,100 back. Now compare that to a family earning over $43,000. Their rate drops to 20%, which is where most families land. With the same $6,000 in care expenses, their credit would be around $1,200. This example shows how the percentage and the expense limits work together and why income plays such an important role in the final credit amount. There are 2 main education credits that can help with tuition cost: the American Opportunity Tax Credit and the Lifetime Learning Credit. They both reduce what you owe, but they work in very different ways. The AOTC is partially refundable and designed for the first 4 years of college, which makes it a strong fit for traditional undergraduates. The Lifetime Learning Credit is non-refundable, but it's incredibly flexible. It can be used for grad school, trade programs, certificate courses, or even a single class. Understanding the differences between these 2 paths help you choose the credit that gives your family the greatest benefit. Let's break down the education credits using the checklist on your screen. The first card walks you through the requirements for the American Opportunity Tax Credit. It's only for the first 4 years of college and has specific rules around enrollment, eligible expenses, and the student's progress toward their degree. The second card covers the Lifetime Learning Credit, which is much more flexible. It works for graduate programs, trade school, certificate programs, and even single courses. There's no limit on the number of years you can claim it. And the third card highlights the 2 rules that apply to both credits. You can only claim 1 credit per student per year, and you must file the Form 8863 to claim either one. There's also a helpful pro tip. Different students on the same tax return can use different credits depending on what fits their situation. Use this checklist as a quick way to confirm eligibility before choosing the credit that gives your family the greatest benefit. Here are the biggest ideas to remember from this lesson. Credits beat deductions. They reduce your tax bill dollar for dollar. Refundable credits matter because they can put real money back in your pocket. The Earned Income Tax Credit is huge for working families. Don't skip it. The Child Tax Credit is now permanently higher with a refundable portion for many families. Care cost count and the Child and Dependent Care Credit can help offset those expenses. And for education, choose the credit that fits the student. AOTC for new college students, Lifetime Learning for everything else. These credits exist to support working families, caregivers, and students. Understanding how they work is the first step toward keeping more of what you earn. You've got this, friend. My whole goal with Healthcare Insights is to make hard topics feel human, simple, and doable. And I hope today's lesson gave you clarity and confidence. If you want more micro lessons like this, or you'd like to explore other guides on healthcare, finances, and everyday adulting, you can always visit sunnyvibes.com. Everything there is designed to help you feel informed, supported, and ready for whatever comes next. And just a reminder, this lesson is educational, not professional tax advice. For anything specific to your situation, a licensed tax professional or CPA can walk you through those details. Thank you for spending this time with me today.